Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello everyone, Grace Ormsby here. Welcome to a brand new episode of the Smart Property Investment Show. I'm really excited. I can't believe we're already, halfway through February, but it felt time to be doing a little bit of a throw through to what 2022 could look like, especially on the rental side of things for all the investors out there listening in. We're always talking about capital gains and the growth that we have seen in the sales market over the year. So I thought if we turned our attention a little bit more towards the rental side of things, what's going on in there, what people can be expecting from rental prices over this year. Because let's face it, for anyone who does own an investment property, rental prices are, if not as important as that capital growth, they're more important because that's what's bringing in that money week to week. So talking us through this topic today, I'm very excited to be bringing back on board Eliza Owen, the head of Australian research at CoreLogic. Eliza, welcome back to the show.
Grace, thank you so much for having me.
It's always a pleasure to have you on board. And CoreLogic obviously does a lot of work in this space. You're pretty in tune with what's going on in the market. And first of all, I just want to say thank you for all that you do because it does help a lot of the investors who are listening in, even first home buyers are looking to you guys and the data that you're able to provide them to help them feel confident enough to make big decisions in their property portfolio.
Yeah, thank you so much. Honestly, it's an awesome job to have. It's a very privileged position to be in, to research such a vital pillar of Australian wealth and financial stability. So to be able to play such a big role in that conversation is, it's just a really cool place to be in. So thankful all round by the sounds.
Yeah, and I think as well, I don't want to make this conversation all about the pandemic. Everyone's pretty sick of it by this point, but obviously the last couple of years have shown just how important property is to not only the economy, but everyday Australians.
Absolutely. I mean, in the past year, we've seen house prices rise 22%, highest growth rate since the 1980s. And as a part of that, more household wealth has become concentrated in housing through the pandemic. So pre-pandemic, we saw about 52% of household wealth held in the housing asset. That's now gone up to about 56%. So particularly for first home buyers or people who are renting, it's worth considering that by the time you're at retirement age, you've got to be thinking about long-term how you're going to be securing wealth, and Australian property is a big part of that. So, and the other thing is that housing is another way that, as you mentioned there, it's been important for economic growth. These high house prices are not unintended. They are a part of monetary policy, and low interest rates deliver wealth effects through higher property prices and more economic activity directly through increasing transactions and listings and all of the work that surrounds that as well. So I guess again, from that perspective, we've had a big voice through the pandemic and economic performance as well.
Interest rates are definitely something I want to get to a little bit later in the episode, but I do want to turn attention to the rental review that CoreLogic did recently release. Pretty crazy stats in there to have seen so much growth in rental yields over the 2021 calendar year. Was there anything that stood out for you about that report and what was in it?
Yeah, so rent growth is measured by CoreLogic through an index that we create by generating rental valuations for every property on the market and basically looking at the change in the value of that rental portfolio. So the total rental income that we've measured across Australia has increased over 9% through 2021. These are the highest rental growth rates we've seen since 2008. And it's come off the back of a pretty long period of decline in investor activity from 2017, bottomed out around mid-2020 when the pandemic had hit. So your rental supply had gradually been coming down and proportionately less of the housing stock. So initially, it didn't matter so much because COVID-19 created such a shock to rental demand, particularly in big cities like Sydney and Melbourne that relied on overseas migration as a source of rental demand. And what the latest numbers are showing us is that that rental market has just come right back. Rental demand being driven by things like higher income payments to households through JobKeeper and JobSeeker, and also COVID conditions having people seek out more space for themselves as well. So you might think of that as like a share house breaking up, for example, and finding their own rental properties to have more space while they work from home or whatever else. So 9.2% increases nationally over the past year. And some of the strongest rental market growth has been concentrated in resource-based markets like Perth and Darwin. They've seen double-digit growth in rents over the past year. And even though those annual growth rents are starting to ease in the resource markets, it is a reflection of just how strong the influx of rental demand has been there, particularly where FIFO workforces have had to transition to resident workforces amid interstate border closures as well. So you've got those strong headline figures, and then underlying that is a bunch of different trends across the capital cities. So it's been really interesting to observe, and it's a little unlike the property price increases, which have been more broad-based.
Super interesting, I think, as well, having those resource-based markets, as you mentioned, Perth and Darwin. We've heard a lot about them recently, seeing so much growth, because a lot of people are probably wondering, it's great news for any investors who already were working within these markets, but how will this go sustainability-wise? Will these kind of trends stick around for a few years? Is there still hope for people who are maybe looking to get into those markets, or even for the ones that are already there and possibly doing well at the moment? Could it stay that way? Is it likely to?
Yeah, good question. And look, the answer is probably not. So if we look at the growth rates in rents across Australia, annual growth in rents peaked in November, year to November at 9.4%. It's now eased to about 9.2%. And we expect that annual growth in rents is likely to continue easing in some markets, right? And in most markets, I would say. The reason for that is that when it comes to rental income growth, there is more of a firm ceiling on affordability for renters that is more tied to wages growth, whereas property prices can be influenced by interest rates, the line of credit that can be extended. So the rental income can become more disparate from property values. And we've seen that easily demonstrated in Sydney and Melbourne, where the rental yield compression is a lot more significant, and your typical rental yields are, down to 2 to 3% across those markets. So in terms of the rental income growth, investors may not experience that same level that they have in recent years. But, I do think a lot of the time it still comes back to capital growth for investors. And again, looking at Sydney and Melbourne, where the rental yields are low relative to the values of the property, and yet these are our highest investor markets in terms of the volume of investment properties. So the reason that investors hold out in those markets is for long-term capital growth, which have generally been strongest, particularly across Sydney. So the exception to all of this, and where we could see an outperformance in rental markets over 2022, 2023, is the return of overseas travel, where, if you look at a city like Melbourne, you look at the unit stock, for example, at the start of the pandemic, typical rent rates across Melbourne were about $450 a week. That got down to a low of $380 a week in May 2021, where we'd seen all of these demand shocks play out when international borders closed. Rental values have been trending a bit higher across Melbourne, so they're now sitting at about $400 a week. So not as high as pre-pandemic levels, but it's been tightening, it's been recovering. The return of overseas migration is really going to, I think, put upward pressure on that market and exacerbate growth, because that's the market where overseas migrants would initially settle in large numbers. Same with city and inner south of Sydney, Parramatta, Canterbury, Bankstown, and other pockets of Melbourne as well. Any market that had higher exposure to overseas migration prior to COVID, they're the ones that have seen the most shock to rental demand since international border closures, and therefore would be expected to kind of catch up as borders reopen.
We're going to take a quick break there, but we'll be picking right back up where we left off in just a second.
Looking for a blue chip Gold Coast investment property, or trying to relocate to the beautiful sunny Gold Coast but keep missing out on the right properties? Maybe you need an expert on the ground to source the right property for you. The Srama Group are the leading recommended buyers agency specific to the Gold Coast, providing their clients with exclusive off-market property opportunities, specific insights into market, combined with a large network of dedicated professionals to ensure you make the right decision without the hassle. Get in touch with us at thesramagroup.com.au and secure your financial freedom today.
Welcome back to this episode of the Smart Property Investment Show. I'm joined by the head of Australian research over at CoreLogic, Eliza Owen. Again, Eliza, thank you so much for your time today. It's always so interesting when we get together and chat to talk about what's going on in the market. And I think I'm loving talking about what's going on with rents, because it is something that people do tend to forget about when we are looking so much at capital growth. But on that topic you were talking about just before the break, and the areas where there has been more of a shock for investors and in those markets, obviously we're going to see a return to international travel soon, and a lot of people will be awaiting that. But do you think, I don't know if it's a weird question from my perspective, but is it something that we needed a little bit of an adjustment in there? Were prices going up a little bit more than they maybe should have been? Like looking back to 2020 and we did see such a big shock. Was it purely the absence of that international activity that did cause a lot of that?
I think that was probably the biggest factor. And the reason is that it was highly correlated with the markets that had the biggest shock to rental prices. But there were other factors. I mean, COVID had a lot of disruption to the labour force. And the industries in particular that were hardest hit were industries related to what we would call social consumption. So this idea that you have to be physically together in order to play out the product or service, so hospitality, the arts. And these are sectors where data from the ABS tells us that people working in those sectors are more likely to be renters than in other parts of the workforce as well. So I think when you saw the closing down of, for example, hospitality venues in the inner city, that saw a lot of people maybe move back in with parents if they could, or seek cheaper rents outside of the city while their work was disrupted. And I think part of the recovery that we're now seeing in inner city rental markets could be the return of those workers as well. Though it's worth noting a lot of people who go into those industries, particularly hospitality, are also tied to that recent overseas migration as well. So there's a few different factors that were in that. And then conversely, while we saw all of this demand draining out of the inner cities, there was a lot more upward pressure on outer suburban rental markets within metropolitans and regional Australia as well. Some of the lifestyle markets like Richmond Tweed, the Central Coast, they've seen increases in their rents upwards of 30% in some instances. And that's been a real struggle for some of the people in the regions, but I guess it's also tied to the boom in domestic travel amid the pandemic and the kind of short-term rental accommodation piece as well, where you have a lot more, for example, Airbnb popping up through that time. So, yeah, a multitude of factors, but I do think most of it probably comes back to the overseas migration piece.
So, do you think when we do have that international migration coming back, Will people be moving back away from those lifestyle destinations that we've suddenly had popping up as really trendy for renters to be going? Do you think that will all reverse overnight, or will, I'm just sort of thinking, over the next 12 months, 24 months, will a lot of these trends see a reversal as soon as some international travel comes back? Or are those benefits expected to be a bit more long-term?
Look, I think that the regional trend is something that would just kind of flatten out as we hit affordability constraints. There's going to be a point where domestic demand for regional lifestyle markets is kind of exhausted through the cycle. My expectation would be that overseas migrants would return to the markets that they were going to pre-pandemic, just because there's more job opportunity in inner cities. And they tend to be dominated by, international students as well. So a lot of the university facilities in Sydney and Melbourne. There are some university towns, right, regionally, Newcastle, Bathurst, where those areas would probably benefit from the return of migration as well. But in terms of, a reversal in the trend, I think for all the flexibility that's been necessitated of employers through the pandemic, long term, this will be a structural change. This will be something that enables more people to work flexibly, pursue housing in regional Australia, and overall the regional market is going to be better off because of that fundamental change in employment. Before Delta and Omicron, I wouldn't have said that. I would have said that it made sense for this trend to reverse and for people to come back to cities. But I think the rise of those variants have just proven how long-term the effects of a pandemic can be, and how workplaces have needed to remain flexible, remain adaptable. So I'm not really so sure about the strength of that call to return to cities.
You've sort of jumped in and answered my next question there a little bit, Eliza, which was, for any investors who were looking to buy now and prices have gone up because we've seen capital gains across the board. Can they be confident that higher yields are still going to be there if they are buying into what is already just a less affordable marketplace? And I guess if you're thinking that the trend towards remote work will be more long-term, the logical response to that would be yes.
Yeah, I think so. But obviously there have got to be...
There's some caveats.
Yeah, like there's fundamentals to the areas that have really taken off that have centered on, good infrastructure, commutable regional areas, places that are within reasonable distance to some major metropolitan hub. I mean, they were popular prior to the pandemic. It's just that the pandemic and remote work trends have kind of exacerbated their growth. So somewhere like Southeast Queensland is a really good example of a market that for years has had positive interstate migration. It's just that those numbers were kind of amplified through the pandemic. But yeah, I think, the major structural shift that we've seen in the workforce, flexible remote work went from being a perk of the job to a health necessity. It's really forced a lot of employers to embrace that step. And I think it's fair to say that that's going to contribute to long-term growth in regional Australia. Remembering, though, that property markets have short-term fluctuations. So we're coming into a period where interest rates can only go up. And I imagine that will create a broad-based downturn in property values. There's not an area I can see really escaping that. But just keeping in mind that obviously property is a long-term game. And despite the short-term fluctuations, that values will continue to increase over time.
Absolutely. Some great food for thought there. We're going to take another quick break. We'll be back soon with more from Eliza Owen.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back to this episode of the Smart Property Investment Show. Eliza Owen is on the line. We've been talking rental demand, rental yields, what's going on in those markets over the last 12 months, what we can expect from 2022. And it's all super, super interesting, Eliza. I do want to turn our attention now to interest rates. There's been a lot of discourse around what's going to happen. Obviously, we wish we had an accurate crystal ball, which could tell us what is going to happen, but we don't. We can speculate and we can use the knowledge that we do have and on what's going on in the economy as to predict what we think might happen. But I'd be curious to hear your thoughts on what could happen with interest rates this year, because there is going to be a knock-on effect then through the property market to then land in the rental market. And as you mentioned before the break, that is something that people do need to be paying attention to.
Yeah, absolutely. So I guess looking at some of the recent inflation and unemployment reads, it's pretty clear that the economy is well ahead of where the RBA thought we would be by now. And as of February, they've come out with revised forecasts that see the unemployment rate getting to below 4% by the end of this year, and inflation being well within their target band by the end of this year as well. So inflation is about 2 years ahead of where the RBA thought it would be. Unemployment's about a year ahead of where previous forecasts had put it at. So with all that in mind, it makes sense that with those being some of the guiding indicators around the timing of a cash rate rise, if they're having to revise the economic forecast, they may have to revise the timing of the cash rate increase. So more and more, we're seeing economic consensus lead to a 2022 rate rise that would probably happen after we get some reads off wage price increases. So a lot of economists are starting to say, as early as August. Now, any increase in the cash rate would put downward pressure on property prices. And through this cycle, it's probably going to be the piece that triggers a decline in property values as well. Households are going to be more sensitive to a change in the cash rate now because household debt is so much higher. So I guess that's something to keep in mind. We're already seeing in the fixed rate space that long-term fixed rates are almost back at their pre-pandemic levels. Fixed rates on the 3-year term or less, so shorter term fixed rates, they've started increasing over the past few months as well. And that's going to feed through to, the costs on an investment property. And again, you might not always be able to achieve the rental income growth to cover the interest costs because there is that cap on affordability when it comes to the rental market. So, we could see through wages price growth that you could get a bit more rental income, but just to be aware of those rising interest costs and what that sort of means for your investment decisions as well will be important to keep in mind.
And as you said, it is a long-term gain. So anyone who is looking into mortgages now, those buffers are going to be built in. And obviously you do need to be looking ahead to what potential price increases could be in there. But long-term game, it's obviously up to individual investors what their move is here. But by the sounds of it, still overall a pretty positive sentiment for where the property market is headed in 2022. Is that fair to say?
Yeah, I think so. I mean, CoreLogic doesn't really do forecasts, but we supply data to the major banks who produce their housing market forecasts. And capital growth is expected to be positive for the calendar year before declines in 2023. But again, those are short-term market cycles. And at the end of the day, the upswings have generally been longer and stronger than what we've seen in the downturns. So that leads to long-term capital growth overall. Still it's at $9.7 trillion and still fundamental to building wealth and financial stability. So I think definitely looking out for those opportunities now, such as the inner city rental markets that have seen weaker performance, but will benefit from things like the return of overseas migration, moving to that kind of post-pandemic era. there is still some really good opportunities for people looking to invest.
Eliza, thank you so much for your time today. I know how busy you are. It's something that we've done before, and I would love to make this a more regular thing because there's always so much insight in what you do bring to the show. So thank you again. We really, really do appreciate it.
Thank you for having me.
To everyone who is listening along, I hope you like this episode. Please rate or review us on whatever platform that you do use to listen in. And if you have any questions or if you want to pitch a topic idea for an upcoming episode, let us know at editor@smartpropertyinvestment.com.au. As always, stay up to date with all the latest news on our website as well as our Facebook, Twitter and LinkedIn. Until next time, stay safe and well wherever you are listening in from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Looking to refinance your loan for a better rate? Maybe you're considering releasing equity to grow your portfolio or struggling to find a lender that can meet your needs. Finny is the investment finance specialist that has the solution. With access to over 70 lenders, Finny can track down the financing solution you need. We specialize in investment property finance, and we only deal with lenders that have the right solutions for investors just like you. So you're in safe hands. Fast-track your investment strategy today. Visit finny.com.au for more information.